You're just saying that because you got paper hands. I got diamond hands. What's up, y'all? It's Will here with Bullish. I am the host of Money Drama. Before we get into this angry translation of what Cathie Wood had to say about Jim Cramer and so much more, y'all have to know that Cathie Wood is the CEO and founder of ARK Investment Management LLC. She is a disruptive and innovative investor who has just completely changed the game of investment. And because of that, she often gets like backlash from other people who are not as safe investors as her. If you want a more detailed description of who she is, a link will be in the description as well. And as always, please be sure to subscribe to Bullish for more content like this, and subscribe to Benzinga for providing this amazing interview. So with that being said, let's get into it.
I just want people, when you hear you on TV sometimes, they don't necessarily get your background. And just a little bit on your background, where you're a rule breaker, where you're always seeing things so differently. A couple minutes or a minute on that would be awesome.
Sure. No, I was a really good student, very serious. I born of immigrant parents who, thought education and career were extremely important. So no.
I've been a serious student. I've been about it. I've been about this life. I'm mad serious when it came to school, college, and now investments. I do this.
No rule breaking, but when I started in the business, I really had to scrap. And what I mean by that is Jennison Associates in New York gave me an opportunity. I started in economics, but I wanted to become a portfolio manager. And so I had to become an analyst first. And
what I mean by that ultimately is that it was no holds barred. I've been fighting for my position. I've been leveling up since day one. And that's only through fight. Nothing was given to me.
They gave me the opportunity, but I had to find my own stocks. And so I had to find stocks that nobody wanted. They were a little contrarian. They were what I called at the time fall through the cracks stocks. So the best example, Reuters was the first dually listed stock, New York and London. And it was a database publishing company.
And what I ultimately mean by that is nobody wanted this stock. No one wanted to buy it, but I believed in it. I picked it because I see stuff that people don't see. Even when they going against it, I'm with it.
Publishing falls through the cracks. The tech analyst didn't want it. The publishing analyst didn't want it. It seemed like a strange animal. I wanted it. I was thrilled. And of course, nobody wanted it because they didn't understand this new thing that was happening. It was called the internet. And just
like many things in this current climate, y'all people don't understand about these stocks that may seem risky or not a safe bet. We don't know about the future, but I'm all in on it because I want to get in on it before everyone else does.
At very, very early stages. So I learned early that way. And I also learned because we made a big bet on inflation and interest rates peaking in the early 80s when I first joined Jennison. And no one was expecting that. So I learned very early on, if you have good reason to expect something to happen that nobody else expects, the odds are high that you'll do very well with that bet if you're
just
right.
Like I mean when I say in this current climate, when people are going against it, I'm with it. If it's disruptive, if it's innovative, if the world needs it and people need it and it solves a problem, I'm betting on it.
Now, speaking of that, so you were at Jennison for 18 years.
Yes.
And then I think you went to Alliance Bernstein, right? And there you had the exact same situation. You were made fun of. You may have been ridiculed, picked on, as they say in school. I don't know. But I remember Amazon. You were buying Amazon, and literally you had your investment meeting. And tell us that story.
Yeah, we were buying Amazon. It was $5 billion in market cap. I think it's up to 1.7 trillion now. So this was 2002. And I had to announce my trades every Monday morning. I announced Amazon, and you could have heard a pin drop.
You could have heard anything drop in that building because I went in on Amazon when people weren't. They were against it. They didn't get it, but I got it, okay? Those old ass people didn't know about the internet, and it was earlier on. But I saw the opportunity in the internet. I got in on it, and now I'm up millions, close to billions. I do this shit.
What? And, at that time, the internet was considered a figment of Wall Street's imagination. So many people had gotten hurt. Amazon, I think, was down 80% from more than 80% from its peak. And no portfolio manager or analyst wanted to admit ever having held or recommended an internet stock. But we were convinced. I had 3 little kids at the time. I had no time to shop. I did all of my shopping on Amazon. Did I get everything? No, there were all kinds of problems with it. But
check it, I had babies, all right? I've been having babies, 3 babies that I went on Amazon for, and I shopped for them since Amazon came out. Before we had Prime and it's delivered in 2 days. It took 2 weeks or a month. But I'm still in on it. Look at these other companies that take forever to deliver, like Wish and June and all these other apps. Okay, Amazon been ahead of the curve, and that's why I went in on it.
I was delighted because I didn't have to go to the store. And I just knew online was going to become a big deal. And yet the psychology of the moment was so thick. Understandably, there were a lot of risk control experts guiding portfolio teams, saying, this internet thing, no earnings, you got to have the earnings. As you know, Tesla wasn't going to have earnings for another, I think, 10 years. Yes, going against the grain. In fact, sometimes when the sentiment is so negative and we have good reason to believe that something differentiated is going to happen, unexpected. Those are great times.
Anytime people are overly negative on the stock, it's because they're scared. And when people are scared, you got to be greedy, in the great words of Warren Buffett.
The valley of death. It's a saddled S-curve. The first saddle S-curve, it's kind of a fake out. Too much money chasing too few opportunities too soon. That was the internet, late 90s. Then in the mid 2000s, early to mid 2000s, valley of despair. Nobody wanted anything to do with these stocks. And then that's a great time to pick up stocks. And
that's
right now,
always a great time to buy what I call the dip. Okay, it's dipping because people are fearful until the company proves themselves, and then everybody wants to get in on it. But I got in before all of that. When it was counted out, I went in. Diamond hands, bitch.
3D printing stocks have been there for a long time. And then you enter the sweet spot of the S-curve, and it's unstoppable.
And that's okay. And that's where you take this differing viewpoint than the average person. I mean, when you came out and make a pick like Tesla or Amazon, it's a differing viewpoint. So then you left AllianceBernstein, you started ARK. I mean, that's a big risk. You're the CIO at AllianceBernstein. Did you fund it yourself? Do you have, like, how did that happen? How do you go from A to B?
Well, you're right. And many people said, why didn't you retire?
Because why would I retire? I'm making bands up in this hole. I don't need to retire. There's more money to be made. I love this shit.
The reason is I love this business, but I wanted the opportunity to demonstrate that we didn't have to pay attention to benchmarks to guide our investing, whereas most traditional asset managers use the benchmark as their guide. It is the bogey against which analysts and portfolio managers are graded. Innovation. That didn't exist in the marketplace. Again, innovation was out of favor. It was too volatile. In fact,
they've been saying that innovation is out and that you can't do this. People are never going to need this. They always count it out until it starts to work. And that's the thing. That's the thing with Wall Street. They just don't get it, so they automatically write it off like it's for their taxes. We don't do that. We see it. We're like, this is going to be huge. This has to help people. All right, I'm in on it. This has to. And look at what has happened. We up millions, 20% a year and more.
We started the firm in 2014. It took a lot to get people's attention because they thought we were too risky, too crazy. And I see now it's coming full circle because I hear that again, but it's much less risky than we believe the benchmarks are. The benchmarks are filling up with value traps because the innovation platforms, there are 5 of them, and they involve 14 different technologies that are all taking off right now. They are going to disrupt and disintermediate the traditional world order. So I think
so basically, That shit is going to change the world and change the game. And it's going to go through their benchmarks. You know, they got benchmarks, which is basically a prediction for a year to like 18 months. Nah, I'm looking at 5 years to 10 years. Tesla at 1 million. All right?
Is in the benchmarks, not what we're doing.
Got it. And you guys can read about these different verticals at ARK-invest.com.
Yes.
And that we will get into that, and we'll get into transparency, but bear with me, we'll get to it.
So if you talk to most analysts and portfolio managers, they're really focused on the next year or 18 months in terms of guiding their buy and sell decisions. We are not. And in fact, we want our companies to sacrifice short-term profits in order to be in the pole position to win.
So basically, we're not about them short-term gains. We're about them long-term gains. You can't have paper hands investing in the shit that we recommend. You can't have no charming hands, all right? You got to hold on to it. Of course, the ride's going to be a little rocky. You might get cut up a little bit. That's why it's called diamond hands, bitch.
These winner take most markets. Artificial intelligence is causing a lot of winner take most markets. The companies with the best data, the highest quality data are going to win. Tesla in the autonomous taxi network world is one of those examples. So by definition, then, if our companies are investing aggressively now for going short-term profits, their valuations are going to look very rich. And that's probably the biggest criticism we get. It's on today's valuation, next year's valuation. If you give us 5 years, however.
If you give us time, all right? Y'all investors are so in a rush and y'all always got something to say. This is a time game. This is a marathon, not a sprint, all right? This is a marathon. Don't invest in our shit if you need the money tomorrow, all right? You tucking money away for like a rainy day, and then 5 to 10 years, you'll be up millions. Then you can retire in luxury. All right, this shit ain't easy. Stop complaining. 5, 10 years. That's how long you should be investing for this shit to really pay off. All right, people who got into Tesla early, they sitting high like kings and queens. All right, shit.
And given the exponential growth rates we're talking about, say 82% growth on average per year in the electric vehicle market, if you give us that, we are managing value portfolios. I truly believe that. Now, a year ago, I would have told you deep value portfolios. But of course, the market has recognized Tesla and many of our genomic stocks and many of our innovation themes, period. But we still, and I get this metric every day, we still expect north of 20% compound annual returns from our portfolio over 5 years.
20% of compound annual interest per year. That means 20% per year that you're up on your money. In 5 years, you've doubled your money. And in 10 years, you've 200%ed your money. Okay? So, in English, if you invest $1 million, in 5 years, you'll be up $2 million. 10 years, that will be $3 million. This is a long-term game. All right, give me time. Give us time. All right? We're not investing in things that are not going to work. This is for the future. The future. Hold on to it. Diamond hands. Bitch.
That's more than a doubling.
That is an awesome story. And then that's amazing. And that's your transparency. That's what your transparency is, and people aren't necessarily like used to it. So, we're going to transition to something. I'm going to show a clip from a show, you guys, Jim Cramer. I'm going to show this clip real quick and have you respond to it.
Memo to Cathie Wood: close your fund, close it. Listen to what the late Jack Bogle would say: close it. Concentrate on performance, not on trying to deploy capital. It's okay. It's no sin.
Okay. Now, I should just shut up and let you take over your response.
Well, he's talking about the ETFs. It is not possible to close an ETF. It's just not possible.
Your old ass is behind with the times. You cannot close an ETF, meaning you can't cancel it. Once you open it, you can't close it. You're just saying that because you got paper hands, bitch. I got diamond hands. Don't get mad. Appreciate. Don't hate.
So I think he's referring to the mutual fund industry, and that's not what we are. But I think the other mistake that that commentators are making is that they don't understand that I have nothing to do with the flows. In other words, the ETF ecosystem outside of ARK, the market makers, the authorized participants, they are creating and redeeming baskets of stock, which are the stocks we're invested in. But I'm not having to invest those flows or raise money to satisfy redemptions at all.
So basically, what I'm saying is that companies cannot buy back their shares from what I'm investing in. Okay, I'm investing to invest. I'm investing for my firm and for the people who want their money to work for them. Okay, and then for the long term, not just the short term, the long term. These shares that I'm buying, they are not under some contract or to be redeemed from a company when the stock reaches X. It doesn't work that way. I'm investing for the long term. I never have to give back these shares that I'm investing in back to the company, because that's what I do. I don't want anyone to maximize my profits or to get in the way when it's really a runner. I
am investing, pure and simple. I am making investment decisions. I am not dealing with flows. This is such a luxury in a volatile market to be able to focus only on the investing side and not to be forced to do anything because of flows one way or the other. And from that point of view, I think ETFs are a superior wrapper for the portfolio manager. Now, mutual funds have their place in defined contribution funds and so forth. I'm not putting them down, but I think ETFs for an investor, a portfolio manager, are a better wrapper.
Which means I can maximize on the investments that I'm making. I don't have to give them back. I can let winners run, and I can cut losses where they're short and where I see fit. I control everything without someone else getting involved and being under a contract, which basically means diamond hands for life, bitch.